One stock fell 60% in a single year. The stores are still open, the menu hasn't changed. You will still find people queuing up on Sunday evening. So, what actually broke? By the end of this video, you will know exactly what happened inside Sapphire Foods, and more importantly, you will walk away with 5 metrics you can use to check any stock before you put your hard earned money into it. Stay till the end because metric number 3 is one most retail investor completely ignored, and it's the one that actually predicted this crash of Sapphire Foods. And the small request to everyone who are watching this video, please do subscribe the channel so our channel can reach 1000 subscribers. Thank you very much. Now back to the let's clear upon one thing first because this confuses a lot of people. Sapphire Foods does not own KFC or Pizza Hut. Those brands belong to an American company called Yum Brands. Sapphire is what we call a franchisee. Think of it like this: Yum Brands is the owner of the famous name. Sapphire pays a fee for the right to open and run KFC and Pizza Hut outlet, but only in certain Indian states plus Sri Lanka and Maldives. Sapphire runs the kitchen, has the staff, pays the rent. Yum still get its fee whether Sapphire makes a profit or not. That is very very important. So when we say the stock fell 60%, we are not talking about KFC as a global brand. We are talking about the Indian company that runs these stores on the ground. And everything I'm about to show you or tell you comes directly from Sapphire's own quarterly results, its investor presentation, and management commentary on earnings call. Not opinion, company's numbers straight from the source. Here is the stock price story in numbers. In 2025, Sapphire Foods touched a high of 374 rupees. By March 2026, it hit a low of 152 rupees. That's a fall of nearly 60% in about a year. Now, here is the part that confuses most beginner investor. Revenue was not falling. In the December 25 quarter, Sapphire posted its highest ever quarterly revenue, 814 crore rupees, highest ever. And in the same quarter, the company posted the net loss of 4.8 crore rupees compared to the profit of 12.7 crore rupees 1 year earlier. Read that again. Record sales and a loss. This is the lesson number 1 for any investor watching this. Revenue growth alone tells you almost nothing. What matters is whether that revenue is actually turning into profits. A restaurant can be packed with customers every single day and still lose money if the costs are still rising faster than its sales. For the full financial year ending March 2026, Sapphire's loss widened to 32 crore rupees compared to the profit of 19 crore rupees the year before. That's 4 quarters in a row of losses, not one bad quarter, a defined pattern. So, where did the profit disappear? Two places, and this is where it gets genuinely interesting because Sapphire actually runs two very different businesses under one roof. KFC was the good news story. Revenue grew 11%, the profit margin on individual KFC restaurants was close to 19%, which is a solid number in this industry. Pizza Hut was the opposite story. For the full year, Pizza Hut India's revenue fell 7%, and in the January to March 2026 quarter, same store sales for Pizza Hut, meaning sales from the outlet that were already open and running, fell 7% in that quarter alone. Even worse, Pizza Hut wasn't just growing slowly, it was actually losing money at the same store level. Imagine two shops owned by the same person sitting on the same street. Shop number 1 has a line outside every evening. Shop number 2 loses money every single day it opens its shutters. That's Sapphire Food in one line. KFC was carrying the entire company on its shoulder, and Pizza Hut was the dead weight pulling it down. Now, add the cost side of the story. Staff cost went up sharply, and the big part of that came from labor law changes that added extra expense almost overnight. Rent keep climbing, raw material cost keep climbing, and Sapphire was still opening new stores through all of this, which means upfront money before those new stores start adding any profit at all. So you had a weak brand sitting inside the business, rising cost on every front, and on top of that, Indian consumer was simply spending less on eating out. This last part was not unique to the Sapphire. It was happening across the entire quick service restaurant industry in India. But Sapphire, carrying Pizza Hut's problem, felt the pain harder than most of the other players. Now, here is where the story takes a sharp turn. In January 2026, Sapphire announced it would merge into Devyani International, a bigger rival that also runs KFC and Pizza Hut in India. On paper, this sounds like a good news. Combine two companies, cut duplicate cost, get stronger bargaining power. But watch what the market actually did on the day this was announced. Devyani International stock jumped nearly 8%. Sapphire stock fell on the same day for the same deal. Why would the smaller company stock fall on merger news? Because investors weren't reading this as a two equal joining hands. They read it as the weaker player being absorbed by the stronger one. less of a partnership, more of a rescue. Now, let's get to the part that actually makes you a sharper investor. The metric you should be tracking or checking on any company, not just this one. Metric number one, ROE, return on equity. In simple terms, for every 100 rupees shareholders have put into the company, how much rupee of profit does the company generate in a year? Higher is better. Sapphire's ROE was around 7.9%. Now compare that to Jubilant Foodworks, the company that runs Domino's Pizza in India. Jubilant's ROE was 15.46%, almost double. Same industry, same country, completely different quality of business. And metric number two is ROCE, return on capital employed. This tells you how efficiently a company uses all the money invested in it, including borrowed money, not just shareholders' money. Sapphire's ROCE was just 4.34%. To put in that perspective, you'd likely to earn more by simply parking that money in a fixed deposit with zero business risk attached. That single number tells you the business wasn't earning enough on the capital it was using. The metric number three, and this is one of the most retail investors skip completely, same store sales growth or SSSG. This measures how much more or less existing stores are selling compared to the last year without counting new stores. New store opening can hide a weak core business because more store naturally means more total revenue, even if each individual store is struggling. Pizza Hut's same store sales falling 7% was the real warning sign, hidden underneath a headline number of record total revenue. If you only look at the total revenue, you get fooled. If you check same store sales growth, you can see the real issue with the company. Metric number four, operating margin, meaning how much profit a company keeps from every 100 rupees of sales after paying for ingredients, staff, and rent, but before other cost. Sapphire's margin was around 16.5% and it was shrinking down from close to 18% a year earlier. Shrinking margin while revenue is growing is one of the clearest signs that the business is losing pricing power or getting hit by rising cost which it cannot pass to the customers. Metric number 5, debt to equity ratio, which simply means how much a company has borrowed compared to how much shareholders have put in. Sapphire ratio was close to 1, meaning for every rupee of shareholders' money, there was almost an equal rupee of debt sitting on the books. That's a meaningful leverage business for a company that was already struggling to turn a profits. Now, let's zoom out and compare Sapphire to its closest peer because this is exactly what a fundamental investor should always do. Never judge a company sitting alone in the room. Always place it next to its competitor first. Jubilant Foodworks, which runs Domino's Pizza, had an ROE of 15.46%, which I told earlier, almost double Sapphire's. Stronger brand recall, stronger execution, stronger return for shareholders. Westlife Food, which runs McDonald's in West and South India, actually had a weaker number than even Sapphire on some counts, with an 3 years average ROE of just 0.43%, an ROC of 2.31%, and yet Westlife was trading at a far higher valuation, a price to earning ratio above 200 compared to Jubilant's roughly 117. This tells you something every investor need to remember. Sometimes the market price a stock based on the future hope, not current number. Always check whether the stock price matches its actual performance or whether it's simply riding on brand appeal. So why did Sapphire Food really fall 60%? Not because KFC or Pizza Hut became less popular in India. It fell because as an investor, you would have been putting your money into the business with a weak return on capital, a shrinking loss-making brand sitting inside its portfolio, rising cost it couldn't control, and the valuation that eventually had to catch up with the reality. Here is a takeaway to carry into your next stock pick. A famous brand name on the signboard tells you nothing about the quality of the business standing behind it. Before you invest, always check who actually controls the pricing and the profit, whether same store sales are genuinely growing, and whether the company is earning a real return on the capital it's using. Sapphire Food look exciting from outside. The numbers straight from the company's own results told a completely different story. That's it from my end. Please do subscribe the channel, like the video, and if you have any questions, please put in the comment section. Thank you very much.